Hey guys, it's Mike with Financeable here. It's Friday, which means it's time to answer the weekly challenge question. By the way, if you like these videos, definitely hit the like button down below and subscribe. We've got a lot more coming. Let's hop in here. So this week we have our first three-statement flows question that has two steps to it. So we're going to do 2 years of entries here. The question is, we have a company that purchases a $100 piece of equipment with 50% debt and 50% cash at the beginning of year one. And then at the beginning of the subsequent year, they actually write off the entire piece of equipment. We assume a 20% tax rate, and the question is, what's the asset balance at the end of year two? So that's our question. Let's hop in here. So to kick things off, we need to first calculate our depreciation for the piece of equipment. We have a $100 piece of equipment that has a 10-year life, so we'll have $10 of annual depreciation. And then we're going to work through our 4-step process to answer the questions around three-statement flows for year one. So down below, we're going to incorporate our $10 deduction for depreciation. And this lowers our taxable income. So we're going to multiply that negative $10 by the negative of our tax rate to reflect the fact that this lowers our taxable income, and then we get a tax benefit for this. We'll sum this up, which completes step one, and now we have net income. We'll now go to step two, which is pulling net income over to our cash flow statement. And now we have to work through each of the items of the cash flow statement to get to the change in cash. The first item here is just adding back the non-cash charge that we deducted in the income statement, which is depreciation. And that gets us to cash flows from operations of positive 2, which is really just the cash tax savings from the depreciation deduction. We also purchased a piece of equipment, and we need to reflect that. So we have a negative $100 outflow for the purchase of the equipment, but we financed half of that purchase with debt, so we have a positive 50 in cash flows from financing to reflect the fact that we borrowed half the purchase price. With that completed, we can add cash flows from operations, cash flows from investing, and cash flows from financing to get to the change in cash for the business. That completes step two, and we can move to step three, which is just connecting cash and retained earnings, so we can think about the last step for year one. So to kick this off, we're going to pull our change in cash over to our cash balance. So we'll grab that negative 48 here, and then we'll pull net income into retained earnings. That completes step three. Now we just have to complete step four, which is filling in the pieces. Well, what happened here? We purchased a piece of equipment and incurred $10 of depreciation. So it's negative, flip this around here, negative of our negative 100 to reflect the positive PP&E balance. And then we're going to add in the negative depreciation to reflect a $90 net balance at the end of the year. On the other side of the balance sheet, we borrowed, I keep flipping my signs here, we borrowed $50, and that gets us to a balanced balance sheet for year one. Now we need to move over to year two. In year two, we start by writing off all of the equipment that remains. So we have a negative $90 write-off because that was the balance of the account at the end of the last year. And then we're going to record the tax impact of that, which again is negative 20% times our taxable income. So we actually get a tax benefit from that write-off. We add these things up, and that gets us to a net income impact of negative 72. Then we carry this over in step two to our cash flow statement. And now we need to actually add back that write-off because it's a non-cash charge. So we'll grab the negative 90 here and add it back. And that gets us to $18, which again is really just the cash tax impact of the write-off. We didn't purchase anything, and we didn't borrow anything. So our change in cash is going to be CFO, CFI, CFF, a change of $18. That completes step two, and now we can move to step three, which is again connecting cash and net income here. Now remember, we have a starting balance now for the prior year. So this year we're going to take the prior balance and then add the change in cash to that prior year's balance. Down below, same deal with retained earnings. We're going to take the prior year's balance, the ending balance, and then add in the net income that was generated during the year. And again, we have to fill in the pieces. Again, it's always good to ask yourself with this step four, what happened here? So with this final step, it's, okay, well, what do? Well, we wrote off a piece of equipment. So we have the prior year balance plus this $90 write-off. And then debt stayed the same. So we're going to keep debt at $50. And once again, we're balanced out. And the answer to your question for the year 2 asset balance here is -30. Now, clearly, you can't have a negative cash balance like we did in year 1 and probably not a negative asset balance like we did in year 2. So in that sense, this exercise is a bit academic. But what's not academic is the fact that 2-step, 3-statement flow questions often pop up in interviews, and you want to be able to answer them. And it just takes a few iterations through these questions to really be able to pin them down. And that's why we put this into our challenge question series. As always, thank you so much for taking the time to check out our videos and for participating on the polls on LinkedIn that create these videos. If you found this video helpful, definitely hit the like button down below and subscribe. We've got a lot more coming. Hope you have a nice weekend. Take care.